Hi, my name's Alan Madden from Madden Chartered Accountant. I'm an accountant in the Mississauga region helping business owners, investors, and individuals. Today I'm going to talk about how to save corporate income taxes. Tip number 1. Pay yourself dividends instead of salary. The advantage of dividends is that, firstly, the first $40,000 of dividends can be received on a tax-free basis. That's a lot of money. Secondly, dividends are not subject to Canada Pension Plan premiums. CPP premiums are 9.9% of the drawings that you take, up to a maximum of $4,000. There are some advantages with salary. First of all, salary, unlike dividends, qualifies for earned income purposes, which means that the more salary you take, the greater your RSP room increases. If you're an avid saver and you'd like to contribute to your RSP, then salary is the way to go for you. Salary is also subject to CPP premiums. Therefore, if you wish to receive Canada Pension Plan payments upon retirement, then it's a good idea to contribute to CPP and therefore pay yourself salary. Tax tip number 2, shareholder loan repayments. What's a shareholder loan? A shareholder loan could be expenses that you have paid on your corporation's behalf and therefore your corporation now owes you. It could also be money that you've lent your corporation for startup expenses or for operating expenses. As said, shareholder loans can be paid on a completely tax-free basis. So let's say you have $100,000 in shareholder loans owing to you by your corporation. It would make sense, therefore, to pay yourself the $100,000 first before you start drawing income from salary or dividends, both of which are taxable. Tax tip number 3, loan to spouse. If your spouse is in a lower income tax bracket than yourself, it's a good idea to lend your spouse some money. That money can be invested by your spouse in income producing or capital gains producing investments. Examples could be real estate, it could be stocks, bonds, mutual funds, interest savings accounts, etc. The income and capital gains earned by your spouse on the investments, which were again sourced from the loans, would not be attributed back to you as the higher income earner. Therefore, as a family, you end up saving money, tax money overall. Tax tip number 4, gifts to children. Similar to the spousal loan idea, you could give your child a gift. The advantage of doing so is that, well, your child will be happy, but secondly, capital gains earned by your child on investments are not attributable back to you as the parent. So let's say you buy a piece of real estate for $100,000 and gift it to your child. Over 7 years, it appreciates to $200,000. The capital gain of $100,000 would be taxed in your child's hands and not yours, thereby saving your family in taxes overall. Tax tip number 5. Now this is one of the most important tax tips, so please pay particular attention to this. Tax tip number 5 is minimize taxes by incorporating. Corporations have a very low tax rate, small business corporations in particular in Canada. We, in fact, as Canadians, have among the lowest corporate income tax rates among the G8 nations. A small business corporation in the province of Ontario is taxed at a combined federal and provincial rate of only 16.5%. Now compare that to an individual at the highest marginal tax bracket who is taxed at 46.4%. That's a very high tax rate. So therefore, you could save approximately 30% by incorporating. If you're an avid saver and you can keep your money inside the corporation and not spend all of it by taking it out as drawings, then you can take advantage of tax deferral, meaning that you're leaving it in the corporation to be subject to that low corporate tax rate of only 16.5%. Tax tip number 5, employee home purchase loan. This is a great tax saving strategy that I've implemented for my clients. It goes as follows. You have some money in your corporation, let's say $50,000, and you want to purchase a home. You are an employee of your corporation on the books, so you receive a T4 at the end of the year and are receiving a salary. You can take that $50,000 tax-free from your corporation and use that as a down payment on your home, the home that you're going to live in, of course. You have to repay the loan that you've taken from your corporation over a reasonable period of time, and you must also pay your corporation interest. But then again, you're paying interest to yourself, so you really don't care. How else could you get $50,000 out of your corporation tax-free to buy your own home? Tax tip number 7, dividend sprinkling. It's not really what it sounds like, but it's an income splitting strategy. For example, let's suppose that you and your spouse are both shareholders of your corporation. You could pay dividends to yourself and your spouse, let's say $40,000 each, and conceptually receive $80,000 in dividends without paying a cent of tax. That's much better than paying yourself $80,000 of dividends only to you and having to pay tax. So you can see that by paying dividends to one or more family members, we are able to reduce the overall tax rate paid by the family. Tax tip number 8, pay a salary to your spouse or family members. Your spouse will be happy because he or she is getting some income, and you're also happy because the salary paid to your spouse or family members is tax deductible to the corporation. And if your spouse or family members are in a low tax bracket, very little tax is paid by them. You have to pay a reasonable salary to your spouse or family members. So you couldn't, for example, pay $50 an hour to your nephew for cleaning your office and for filing. That would be challenged by the CRA. Tax tip number 9, pay yourself a tax-free automobile allowance. Let's say you own your own vehicle, it's in your name, and you use that for business purposes. You can pay yourself a tax-free automobile allowance for up to 52 cents for the first 5,000 kilometers that you drove for business purposes, and 46 cents per kilometer thereafter, with no limit on the number of kilometers driven. So if you drove, let's say, 30,000 kilometers in the course of the year for business, you could have your corporation write you a check for $15,000 and not pay a dime of tax. Tax tip number 10, interest deduction. This is often overlooked, but is a valuable deduction. If you borrow money to invest in your business and pay interest, the interest that you paid is tax deductible. Also, let's say you borrow money from a bank or your credit card or some other source and have to pay interest on that money. A good tax strategy is to, in turn, charge interest to your corporation. That interest paid by the corporation to you would be tax deductible to the corporation. The interest income received by you from your corporation would be offset by the interest that you have to pay to the third-party bank or credit card company, resulting in zero income tax except at a personal level for yourself. I'm glad that you tuned in on how to save corporate income taxes. It's been my pleasure. If you'd like to learn more tax savings ideas and more about Alan Madden, Madden Chartered Accountant, please tune into my website, maddenca.com. That's MADANCA.com. Thank you very much and look forward to chatting with you soon.